Hey everybody, welcome back to Investing with Wesley. You know, a lot of people in my Velocity Banking episode have asked me just exactly how you do it. How do you move money from each account to effectively lower your interest rate? And just how do all the numbers work out? So in today's episode, I'm going to go into more detail on how Velocity Banking works and give you actual examples on how it is extremely effective. Let's get into it. So for starters, let's recap what Velocity Banking is. Velocity Banking is by far the fastest way to pay down debt, and it works by effectively lowering the amount of interest that you pay on all your debts, so more and more money goes to principal as opposed to interest, thus drastically lowering the amount of time you remain in debt for. So today I'm going to show you how to pay off over $14,000 in debt in just under a year. This $14,000 comes from an auto loan, so it's a fixed loan at the fixed rate of 3.69%. The minimum payment on this loan is $380 a month and is set to be fully paid off by August of 2024. But that's not good enough for us. We want to pay it off now, or at least as quickly as humanly possible. What do? Well, we start by opening up a line of credit. Velocity Banking more often than not takes place with a home equity line of credit. Now this is because the home equity line of credit is secured by your home. So the interest rate you pay is a lot lower than, say, a regular line of credit. But I don't like the idea of risking my home just to pay down debts quicker. So we're going to use a regular signature line of credit that you can get at any bank or credit union. So the line of credit that we apply and get approved for is a $10,000 limit that has an interest rate of 7.79%. And is required that every time you make a payment, it has to be at least 1% of the total balance. This is how most line of credits and credit cards are structured. Whenever you see the minimum payment, it is at least 1% of whatever the balance is that you owe. The other two numbers you have to remember is our income and expenses. In this example, our income is $6,000 a month, while our monthly expenses is $4,500 minus the minimum payment of this loan. So here's a crude spreadsheet that I made on Microsoft Paint just so you could see how things work. On the left-hand side, we have our loan. In this case, it's the auto loan. And on the right-hand side, we have the line of credit. So how this works is that you have $14,000 worth of debt in this auto loan right here. Now what we're going to do is move a portion of this debt over into the line of credit. So we're going to move $10,000 from your loan over into the line of credit, basically maxing out your line of credit. You have no available credit left because all $10,000 has been moved over. This is your balance here of $10,000, and now you only have $4,000 left to pay on your loan. So now that there's only $4,000 left on your auto loan that you'll still be paying $380 a month minimum payment on, and $10,000 on this line of credit, let's see what happens to Velocity Banking and how it is so powerful. Well, in the rule of Velocity Banking, you're going to deposit all income you receive each month into your line of credit. So $6,000 goes as a giant payment towards the 10, and now you're left with $4,000. Now obviously you still have a bill to pay, you still have a life to live, and you're gonna have to pay for expenses. So what do we do with those expenses? Well, we put them on a credit card. And this credit card should be either a miles, reward points, or cash back card, just so you get a little bit more benefit out of it and a little bit more bang for your buck. So now our total debt is only $8,000 because $4,000 of it is over here, and another $4,000 is now here because you used your $6,000 in monthly income to offset the amount of debt that you're accruing interest on. Now usually what happens at the end of the month is you withdraw money from your line of credit to pay for your monthly expenses. So we're going to withdraw money here from our line of credit and pay off our $4,500 credit card balance in full on the 25th of every month. So once we do that, the balance of our line of credit now goes up to $8,500 as depicted here. The following subsequent months, we just repeat the exact same thing until everything is paid off. Let me demonstrate. The very next month, you get paid another $6,000 and you put that into your line of credit as a huge deposit, thus lowering your account value to $2,500. The same thing, you put all $4,500 onto this credit card, and at the very end of the month, you use your line of credit to pay off that credit card. What happens? Your balance goes up to $7,000. After your income goes in, your balance goes down to $1,000, and this is what's going to be accruing interest, this lower amount the entire month up until the 25th of the month when you withdraw. So you withdraw again to pay off your credit card's worth of expenses, and now your balance is $5,500. Now, because $5,500 is less than $6,000, you're going to actually have a surplus remain in your checking account to cover some of those expenses. So the following month, when you get your $6,000 worth of income, you're going to deposit $5,500 of it, thus making your line of credit balance equal to zero. The remaining $500 is going to stay into your checking account to cover some of those expenses that you're going to have throughout the rest of the month. So because we still have to pay off those credit cards worth of expenses, now our balance is $4,000 because $500 of it was actually cash that we covered ourselves. The following month, same thing, $6,000 goes to pay this $4,000 off, thus making your balance all the way at zero. And after we also factor in expenses and money left over, our line of credit is now at $2,500. And the same thing happens. $2,500 of your $6,000 go here to pay off this line of credit, while the remainder goes in there to pay for your expenses. Now expenses still need to be paid for, so that brings your line of credit back up to $1,000. And the same thing, $1,000 of your $6,000 goes to this line of credit to completely pay it off, because now you also have a surplus to pay for your expenses outright. So the line of credit is now at zero. Well, what about that auto loan that you've been paying down on the side while doing this velocity banking method? Where's that at, and is it paid off already? So you can see here that in this example, there's only 7 monthly payments and withdrawals, meaning it only took us 7 months. Here's 1 month, here's another, 3rd, 4th, 5th, 6th, and finally 7th. After 7 months, we go from $10,000 all the way down to zero. Now, what happened in those 7 months with our auto loan? Well, this is the first month, the 2nd, 3rd, 4th, 5th, 6th, and 7th. So after 7 months, you've paid down the $10,000 line of credit debt that we had, as well as knocked down your actual auto loan all the way down to $1,600. At this point, the next time your income comes in, which would be the 8th month, you have to decide what you want to do. You have to decide whether to pay it off in full because you will have the excess income and cash flow to do so, or to save that cash flow and invest it or do other things with it because you know in just 3 or 4 extra months, that'll be paid off completely. But because this video is about velocity banking and getting out of debt, we have the excess cash flow to pay it off completely, so that's what we're going to do. We're going to pay this $1,600 off completely on our very next check. And because it's less than the $1,500 spread we had between our income and expenses, we'll actually have enough money left over to completely cover all of our expenses that month, so we won't even need to dip into the line of credit funds. So after 8 months, we've completely paid off this auto loan just by using velocity banking. But more importantly, I want to show you something else. What you see here on the screen is the amount of money we've actually paid towards this loan. You see that our original loan value was going to be at $14,810. That extra $810.68 was the interest we would have had to pay on this auto loan. But because of velocity banking, we only paid $14,098.92. And if you do the math, the amount of interest we actually paid on this particular auto loan was 0.7%. Because 0.7% of $14,000 is $98. So we started with a line of credit of 7.79% interest and an auto loan of 3.69% interest. But because of how velocity banking works and the floating interest rate in the velocity banking, we effectively only paid 0.7% interest and the rest went straight to principal. That's the power of velocity banking. I hope you got value in this video. If you did, please remember to like and subscribe because it really helps the YouTube algorithm get this channel out there so I could help educate more people on the very important topic of finance. But until our next episode, have a good one.